Good morning and welcome to The Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Friday, August the 28th, 2026, and we have a genuinely packed show this morning. Nvidia just delivered what may be the earnings report of the year, the AI trade is back in full force, and we've got NFP, consumer sentiment, and Fed Chair Warsh speaking at Jackson Hole, all landing today. Let's get straight into it. Lizzie, Nvidia reported revenue more than doubling year over year and is projecting 70% growth for fiscal 2028. How significant is this for the broader AI trade?
Morning, Robert. This is about as significant as it gets. Nvidia reported $96.2 billion in revenue for the quarter, more than double year over year, and that fiscal 2028 growth projection of 70% is well above what Wall Street had penciled in. What matters for the broader market is that this isn't just an Nvidia story anymore. It's a confirmation that AI infrastructure spending is accelerating rather than plateauing, and that's lifting the entire tech sector in pre-market with Nasdaq futures up around 1% and S&P futures gaining 0.5%.
Nvidia is also reportedly acquiring Hugging Face for $12.9 billion. Does that deal change the investment thesis, or is it secondary to the earnings?
It's more of a strategic layer on top of an already compelling earnings story. The acquisition signals that Nvidia wants to own not just the hardware layer of AI, but the model development ecosystem as well, which has longer-term implications for how dominant they can become across the full AI stack. For near-term traders, the 7% pre-market pop is driven by the earnings and the revenue outlook, and the Hugging Face deal is adding some additional premium around the idea that Nvidia is playing a much longer game than just selling chips.
CrowdStrike is up over 8%, Okta is running nearly 18%, and Salesforce is surging over 12% on its earnings beat and the new Anthropic partnership called Claudeforce. Does this wave of enterprise software beats confirm that AI spending is flowing through the broader tech stack?
It does, and this is an important distinction. CrowdStrike and Okta aren't selling AI chips, they're selling cybersecurity and identity management. And the fact that they're beating and raising guidance tells you that enterprise IT budgets are expanding broadly, not just at the infrastructure layer. The Salesforce-Claudeforce partnership with Anthropic is notable because it plugs Salesforce's data directly into Claude and creates a real switching cost moat, and the earnings beat itself demonstrates that enterprise customers are spending on AI integration rather than just piloting it. When you see Nvidia, Salesforce, CrowdStrike and Okta were all beating in the same earnings cycle, that's a strong signal that corporate AI adoption is moving into production deployment. And on the S&P 500 and SPY specifically, the technical picture is neutral right now, with price sitting around 7,065 on the index and 766 on SP. Momentum mildly positive, but not decisively directional. So today's AI earnings wave could be exactly the catalyst needed to break that indecision.
Nvidia also flagged memory supply as a key constraint and increased purchase commitments. Micron is moving higher pre-market. Is MU the sleeper play in this AI trade?
Micron is genuinely interesting here because when the largest AI chip company in the world tells you memory is a bottleneck and they're committing to buy more of it, that's about as direct a demand signal as you can get for a memory supplier. It's not speculative, it's a purchase commitment. MU has lagged Nvidia meaningfully in this AI cycle, and if supply constraints are becoming the next conversation, memory could be the next leg of this trade that hasn't been fully priced in yet.
Not everything is green today. Wendy's is down over 12% after Trian walked away from a take-private bid. Coles fell 6% despite a $150 million tariff refund and raised guidance, while Ross and TJX held up on genuine organic growth, and Abercrombie is up 37% on a tariff refund, but comp sales were flat. What's the market telling us about earnings quality right now?
The market is getting notably more sophisticated about separating real earnings from one-time windfalls. Coles and Abercrombie both benefited from tariff refunds that inflated their headline numbers. But investors are clearly looking through those items and asking what the underlying demand picture looks like. And for both companies, the answer is thin with flat or negative comparable sales. Ross and TJX delivered organic comp growth of 10% and 4% respectively, and are being rewarded accordingly. And Wendy's is a separate but related lesson. When a stock price is in deal premium and the deal evaporates, the repricing back toward fundamental value can be sharp and fast. So the trade is to wait for the dust to settle before assessing whether there's a genuine entry at post-gap levels.
Steve, let's get into the macro picture. Weekly jobless claims were released yesterday. The prior reading came in at 206,000, beating the 210,000 forecast, and yesterday's consensus was 208,000. What does that employment picture mean for the Fed heading into today's Jackson Hole speech?
The labor market has been holding up remarkably well, Robert. That prior reading of 206,000 came in below the 210,000 forecast, continuing a trend of stronger than expected employment data And if yesterday's print also came in near or below the 208,000 consensus, it reinforces the case that the Fed has no urgency to ease policy, even with growth showing signs of softening. The combination of resilient employment and core PCE running at 3.3% annually, well above the Fed's 2% target, gives Warsh very little room to sound dovish today, and markets will be listening carefully to every word of his Jackson Hole remarks for any signal on the direction of rate policy through the rest of 2026.
We also have NFP dropping today, and consumer confidence and University of Michigan sentiment are both due this morning, with forecasts pointing lower to 51 from a prior 55.2. How does all of that fit together for the Fed?
Today is genuinely information dense on the macro side. NFP is the headline number and will set the tone for how markets interpret everything else. Because payroll data speaks directly to whether the labor market is softening enough to give the Fed reason to consider easing. Consumer confidence and Michigan sentiment, both forecasting a drop to 51 from 55.2, is a meaningful deterioration that reflects the pressure consumers are feeling from elevated prices. But here's the important nuance. Sentiment data alone rarely drives Fed decisions when inflation is running this far above target. And with core PCE at 3.3% annually, the Fed needs to see actual spending and labor market deterioration before any pivot becomes credible. The market has largely priced out September rate cuts, and today's full data flow will either reinforce or challenge that pricing, heading into what could be a defining speech from Warsh.
Lizzie, flipping over to crypto, Bitcoin briefly crossed $80,000 for the first time in 3 months, driven partly by the Treasury's announcement to double long-term bond buybacks. But the technical picture is flashing extremely overbought conditions. Is this a chase or a fade?
The technical read leans bearish here, Robert. Bitcoin is sitting with momentum that historically signals a rally running on fumes rather than building a new base. And when you combine that with a price that has moved more than 22% in a single month, the risk-reward of chasing a new long at these levels looks unfavourable. That said, the ETF inflow data is the main reason you can't be aggressively bearish. 7 consecutive sessions of net inflows, with BlackRock's IBIT pulling in over $284 million in a single day, is the kind of structural institutional demand that can sustain elevated price levels longer than technicals alone would suggest. And total Bitcoin ETF assets approaching $100 billion is a milestone that matters for sentiment. The better trading approach is probably to wait for a healthy pullback toward the $75,000 to $76,000 range before considering fresh entries, rather than buying into an already extended move.
What about Ethereum and Solana? How are those looking technically?
Ethereum is in a similar position to Bitcoin. It's up 27% over the past 7 days, pulled in $1.2 billion in ETF inflows during August alone, and analysts have a midterm target of $2,800, but it's also technically overbought and flashing a lean bearish bias, so the message is the same as Bitcoin. The fundamental story is solid, but entry timing here carries elevated pullback risk. Solana is actually the most stretched of the three, up 27% on the week, with an RSI near 85 pressing right against the upper Bollinger Band, which is a combination that signals exhaustion rather than opportunity. And the technical call there is a clear avoid on new entries despite a compelling fundamental backdrop that includes $4.2 billion in tokenized real-world assets on the network, $1.12 billion in spot ETF inflows, and a $250 price target from Standard Chartered. All of that may prove right over time, but patient traders who wait for conditions to cool will likely get a meaningfully better entry than those buying the top of this week's run.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. Have a great weekend, everyone.